Well, good morning. Yes, it's me, Kenny Polcari, your host of the party, and today is Friday, August 9th, 2024. What a week it has been. But here are the things that you need to know, right? Like I said, it's been one wild week, and stocks are about to take back all of Monday's losses. And so much for that emergency Fed meeting, right? That's out the window. And U.S. initial jobless claims surprise to the downside, igniting a rally in stocks. Oil is up, gold is up, bonds are down, as you would imagine. And what am I having tonight for dinner? Guess what? I'm having a martini, but we'll get to that in a moment. Okay, so let's get this straight, just so we all understand. Initial jobless claims fell, coming in at 233,000 versus the expected 240,000 and 16,000 below last week's 249,000. And on that, the market had its best rally in 2 years? Is that what happened? I mean, I just want to be clear here. The Dow rose by 685 points or 1.7%. The S&P up 120 points, 2.3%. The Nasdaq surging by 464 points or 2.9%. The Russell up 50 points or 2.4%. The transports jumped 255 points or 1.68%. And the Russell equal weighted S&P rose 125 points or 1.8%. Stocks just soared. Bloomberg calling it a solid rebound, which is laughable. Because what happened to that demand for an emergency Fed meeting to slash and burn rates after Monday's action because the U.S. was circling the drain? Monday's debacle was a dramatic move created by, now that we know, Japan raising interest rates last weekend, causing the carry trade to implode, which caused numerous hedge funds who borrowed yen at near zero rates, converted it to dollars, and then leveraged it up, and then went out and bought U.S. stocks over the past year or so, right? Think the Magnificent Seven to lead the pack. So when the cost of the yen went up because rates went up, it put pressure on all those guys that played that yen carry trade, which had been working for quite a while, to suffer some extreme pain. Remember, leverage works both ways, right? It's great when it works, and it's a disaster when it doesn't. And what did they all have to do? Yep, you felt it. They all had to sell their stocks and pay off their yen loans. And as we know, they all ran for the door at the same time. And boom, the place exploded. And that was the big negative story that only created more negative stories, right, on Monday, causing lots of losses for everyone when most of us had nothing absolutely to do with it, right? We had nothing to do with the yen carry trade, yet we all suffered. And that turned into the U.S. encircling the drain, and unemployment was about to explode higher and blah, blah, blah. You know the story. It had Andy Sorkin from CNBC hysterical in the morning as futures plummeted on Monday morning. It's how it was about also how tech was reported less than stellar earnings, which, by the way, in my book is absolutely not true at all. What's true is that they all took tech to outrageous valuations. Part of this was that upward pressure caused by all those guys that used the yen carry trade to push stocks higher and higher, and especially the tech names. Valuations that many street analysts had been saying all along was absolutely ridiculous. Myself included, I just couldn't get my head around it. But many didn't listen and kept piling in for fear of missing out. So when it all falls apart, Monday happens. Again, exactly why you need to have a plan and not just follow the herd, because many in the herd got smacked and smacked big. And for the rest of us, we also got taken out to the woodshed as well, causing fear and panic for some, only adding to the chaos on Monday. But then yesterday happened. And the same algos and traders that sold it all down on Monday all came back to take it right back up like there's no tomorrow. Many asking, wait a minute, what just happened? So yesterday, the story was not about the U.S. going down the drain anymore, or how JJ screwed it up, or that inflation remains a real issue, but rather it was about how the initial jobless claims fell by 16,000, not 160,000, not 1.6 million, but 16,000. Thus easing fear, apparently, that the labor market is weakening. I want to say, are you kidding me? You had experts like Wharton's Professor Jeremy Siegel and King's College Mohammed Al-Arian all get on TV on Monday and Tuesday and scream about how the Fed and JJ missed the boat. Now they didn't see the signs and they needed to call an emergency meeting, which screams panic in itself, right? To slash and burn rates before it's all over. And then we had the biggest rebound in a year? Really? Okay, this is why people get, angry and confused. All of the major groups in the S&P advanced, right? This is the media made sure to inform us that the claims fell the most in 1 year, right? Trying to create all the drama. And I say, how about it's all how stocks were taken down all to the oversold levels, and all the indexes were left sitting right on their oversold levels, right? See yesterday's note, because we talked about this, the RSIs. And so this tiny piece of news, which by the way, typically is not really a market mover at all, gave the same algos that destroyed the place on Monday a reason to take advantage on Thursday. And so for those without a plan that followed the crowd out, they're all now following the crowd back in, right? It really is a tangled web that we weave. It really doesn't get any more complicated than that, which always speaks to having the plan and sticking to it, just like Warren Buffett, right? Tech yesterday up 3.7%, industrials up 2.3%, healthcare up 2.2%, consumer discretionary up 2.2%, energy up 2%, communications up 2%, financials up 1.6%, basic materials up 1.5%, consumer staples up 1%, real estate up 0.8%, and utilities up 0.1%. The contra trades got whacked. Remember, I told you, those are strategic. They're not long-term investments at all. You use them very strategically. The DOG down 1.7, the SH down 2.2, the PSQ down 3%. The VIX, which declined by 14% yesterday, caused the VIXY to fall by 8%. The triple leveraged SPSX, which is the S&P short, lost 7%. And so you would, as you would expect, the market rallies like that and bond prices decline from what also had been, by the way, a very big bond rally created by the building angst over the last couple of weeks. The TLT ETF fell by 0.6 and the TLH fell by 0.5%. The 2 years now yielding 4.02%, the 10 years yielding 3.99%. Mortgage rates fell to the lowest level in over a year at 6.37% for 30-year fixed conforming. And you know what's so funny? Oil climbed by 1.1% on the positive jobs data. And you know why? Because they say it calms fears over weakening demand. That's laughable. I mean, I can't even explain it. How about we discuss how the Mideast is on the verge of imploding, right? Doesn't that make more sense on why oil might rally? Remember, they sold it down because they thought there was going to be a peace deal. Remember that? Well, that didn't happen. Then they sold it down on the idea that the U.S. was going off the cliff, right? And that demand would crater. Well, that doesn't seem like it's happening. And then yesterday's one report changed all of that. How about we discuss that it was sitting on its oversold line on its relative strength chart, and so it bounced? How's that for an idea? That seems pretty good to me. Oil is now up 7% off the August 5th low, testing the trend line now at 76.57. Right? If it pierces that, then 78.20 is the next stop. Gold, which had been trading in the 24.25, 24.50 very tight range, also broke out to the upside and is now trading at 24.68 this morning. The idea that rates are still expected to decline by 25 to 50 basis points in September helped to stabilize gold. It's now more in the 24.50, 2,500 trading range, and I think that's where it's probably going to stay unless we have another crisis, right? There's no eco data today, so there's nothing to worry about. Next week, though, brings us to July PPI and CPI, along with retail sales, industrial production, capacity utilization, housing starts, building permits, and a whole lot more. U.S. futures this morning are essentially flat. The Dow's down 4, the S&P's up 6, the Nasdaq's up 45, and the Russell is up 5, right? Nothing compared to what we've seen. We're close to wiping out all of Monday's losses, but look, expect volatility to remain elevated. Do not overreact to changes in sentiment over the next 3 months. After all the chaos and calls for an emergency rate cut meeting, Kansas City Fed President Jeff Schmidt told us yesterday that he's not ready to support a rate cut with inflation above target. And Richmond Fed President Tommy Barkin is in the same place. Essentially, no need to rush. Here we go again, sports fans. Swap traders are also reconsidering their aggressive Fed easing bets. I mean, there were some that were calling for a 1% cut in September and then 2 more cuts in November and December, right? Because they were all panicking. At one point, they were betting on a 60% chance of an emergency Fed meeting this week. Talk about hysterical. Anyway, that clearly didn't happen because today's Friday and the week's over. European markets are all higher by about 0.4% right across the board. On Wednesday evening, the S&P closed at 51.99. Last night, it closed at 53.19, up 120 points. So stay tuned. The chaos is not over by any stretch. The recent moves are just a stark reminder of how quickly it can all change. In the end, again, as I always tell you, be confident in your portfolio, become a bit more defensive, and that includes sectors like consumer staples and utilities, etc. Don't go overweight anything at the moment until we get through this kind of weak period. Make sure you know what you're owning. In times like this, talk to your advisor. In case you don't have one, feel free to call me at 212-381-6194. Okay, so for me, it's time for a Grey Goose Martini. For this, you need the vodka, the ice shaker, dry vermouth, 3 blue cheese, stuffed olives, and a bit of olive juice just to make it a little bit dirty. And this is how you order it when you go to your favorite bar, Capital Grill. They make the greatest ones. I'll have a Grey Goose Martini on the rocks, shaken, not stirred, with 3 blue cheese stuffed olives, a little dirty, with a glass of ice water on the side. Stay safe. See you on the other side. Until Monday, have a great weekend.